Hello and welcome back to All Things Money. I'm your host, David Blain. During this segment of the show, we're going to continue talking about what happened in the second quarter. I know a lot of people were concerned. My advice would be to look at your portfolio today and see if you've recovered some of it. The majority of our clients have gotten back above where they were, but caused a little bit of panic there at the end of the quarter. And it was well within the parameters. It was honestly nothing really to worry about, but people in this sort of heightened sense of, concern every time they see something in the portfolio, they really get excited over it, when the reality is investing involves a lot of volatility. So we're talking about a diversified portfolio and designing one to be able to move towards your goals no matter what the environment. You have high growth, low growth, high inflation, low inflation, and all the combination of those. You want to design a portfolio that can do okay in all those environments, because we don't know what the next environment is. We don't know these turning points. If people knew exactly when this would happen, there would be no risk involved in investing, and it would be very easy. And so that's what you're getting paid for. As we've talked about numerous times, you're getting paid to accept the uncertainty. That if you knew for certain you could go out and get 8 or 10% a year on your money, it wouldn't be possible if it was a certain thing. And so you're getting paid for the uncertainty. And if people would realize that, when the market goes up and down and they're not sure if they're going to make 2% or 10% this year, that's what you're getting paid for. That's what over the long term allows you to make more than, frankly, nothing. And since we don't know the future, as I think it was Yogi Berra said, making predictions is very hard, especially about the future. And it's really a fool's game to try to predict what's going to happen in the future. The better thing is to come up with a strategy that does well in various different environments. The other thing that never ceases to amaze me is, if people see a sale at Macy's or they want to buy a car, they go and the car dealer's offering a sale on cars, or a house, you're trying to buy it for the lowest price possible. I mean, nobody goes out and says, well, housing is, I want to pay more than somebody else for their house. But yet, in investing, it's the opposite. When things go down in value, people panic. And the reality is the bonds declined a little bit in the second quarter. Well, guess what? Because they declined, the prospects for the future returns are actually higher now. The yields are actually higher. Remember, as the price of bonds go down, the yield goes up. And so it's to the point now where on a decent, moderate to high quality corporate bond, you can make a 4% yield. It's not bad. So the price of these assets have gone down, but when the price of an investment asset goes down, the prospective return actually goes up. And so if you remember that, and you remember that you're getting paid for that uncertainty, it's not such a big deal. I've been doing this a long time, and the market going up and down, the bond market, stock market, interest rates, GDP growth, up and down, it doesn't bother me at all. And that's the key, is you cannot let this stuff affect you, because long term, there's no way to predict it, and it's not going to help you. You either have a confidence in the sort of capitalist system, or not even the capitalist system per se. I mean, China, you either have confidence in sort of the global economy to grow and to create goods and services that people want. I mean, that's really what you're doing, is that you have confidence that the world is going to continue to create goods and services that people want, need, and desire, and that there are going to be companies and governments, because governments issue bonds, they don't issue stock, that are going to be involved and offer a rate of return to investors. And I happen to think that they are. I mean, if you don't think that, boy, I bet you're miserable. And if that scenario does come to play, then all this investing is going to matter. We're going to be running around, trying to get food and water and things like that. So if you have any confidence at all in sort of the modern human existence, then you're going to get paid for the uncertainty of when the returns are going to come and how much. Well, that's about it for the second quarter. Just to kind of highlight, we had what happened in the second quarter, a couple of things. The Bank of Japan started the quarter off announcing their stimulus plan to inject $1.4 trillion in the economy. We saw Fitch downgrade in the UK's credit rating from AAA to AA+. Once again, a sort of a non-event. I don't think anybody pays any attention to these ratings anymore. The European Central Bank cut its key interest rate to 0.5%. Federal Reserve Chairman, we already talked about that, May 22nd, mentions the possibility of tapering bond purchases, and people, flip out and go crazy. We also had the protests that are up in Turkey as well as Brazil back in the second quarter. I don't know if you remember those or not. But anyway, it was an interesting quarter, but not unlike other quarters that we've seen in history. I thought I'd spend a minute. CalPERS, the California pension system, it's one of the largest pools of money in the world. They invest all the pension funds for employees in the state of California at the state and local, and I think they also have something to do with the university system. But huge pool of money, very influential in the investment industry, widely watched for what they do. Well, they announced their investment returns for the year ending 6/30/2013, and it's very illustrative. They had a decent year, but we'll talk about some subtleties and some things in there that you may not be aware of. But we're coming up to the end of our second segment, so we'll have to pick that up when we come back. We'll also talk a little bit about hedge funds, and these two stories are really interrelated. So for All Things Money, I'm your host, David Blain, and we'll be right back after a few short messages.